Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG Weekly Recap. So, Freddie Mac this past week reminding us that mortgage rates remain near three-year lows. Hooray. But guess what? There's a lot going on right now that we need to be paying attention to. So be sure to listen to the rest of this video. So mortgage-backed securities, as we finish the week, we'll start with from the technical standpoint. Not crazy about the chart. This is almost a garden variety bearish engulfing pattern, and it's happening right at a ceiling of resistance. Not exactly what you want to see, but what I gather from the trading, the candles here to finish out this week, tons of indecision. The bond is not making a clear breakout to new highs, and so that's to be, that's actually kind of rational when you think about what's going on next week. Next week is going to be enormous. We have a Fed rate cut coming on Wednesday, and it looks like right now 25 basis points. We'll get into that in a moment. We also have PCE. Obviously, that's the Fed's favorite gauge on inflation. And we also have the jobs report next Friday. And then on top of all of that, we have US and China in Singapore negotiating. And so as those headlines emerge, that will shake up the market. So the way I'm looking at this right now, we have bonds trading at a sideways pattern, although albeit though a little bit indecisive to finish the week, heading into what's going to be an enormous news week next week. And so you need to have your clients prepared to lock even the longer term ones. If you've been watching the videos and following our stuff, we've really adopted a stance of kind of let's float and see if we can get to the Fed meeting. That would be ideal, but have everybody in the pipeline kind of ready, because this next week could determine, and it could be the breakout of which way bonds go. Do we break out above this ceiling and we move to new highs and new lows in home loan rates? And at the same time, that means maybe the 10-year note penetrates beneath 2% in a convincing fashion. Remember, we've been under 2% maybe for, it seems like, minutes. So, 2% has been a psychological floor on the 10-year note yield. Let's see if we can break that. But next week's going to be a big one. Now, this morning on a Friday, we did have GDP come out, and it was unbelievable. I mean, we were looking for 1.8. It came in at 2.1. So, I'm going to go to the Fed CME tool here. The chance of a 50 basis point cut has dropped a bunch in recent times. We're now at 80% chance of a 100% chance of a cut, 80 of which is now a 25 basis point cut. And you could see here just a week ago, it was like 24%. So it's dropping. So right now it looks like the Fed's in the cut probably by a quarter. I think they have to, because just to keep in pace with the rest of the world, right? We're seeing Europe did not cut this past week, but they did set the stage for more cuts. And also there's talk that they may actually go out into the market because there aren't enough bonds to buy, go out and actually buy stocks. So it's just, what a crazy world we live in right now. But for right now, you're talking to clients, you have to have everybody lined up, because it's tough to overemphasize the magnitude of next week and how it could determine the trend directions of both stocks and bonds, and thus home loan rates for the foreseeable future. So go ahead and enjoy this. Have yourself a great weekend. We'll be back at it soon. Bye for now.